Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of what companies are really saying by reading between the lines of their official filings. But sometimes it feels like they are already telling us exactly what they did, and it is not always pretty in Oatly's case. It is a continuation of a story we have seen before. Oatly Group AB is back with an amendment to an earlier filing, a 6K filing to be exact. And while this is an amended report, the real news nestled inside is their financial statement for the 3 and 6 months ended the 30th of June 2025. So let's dive into what Oatly is telling us about their performance. Right off the bat, these numbers are telling a familiar story for Oatly. For the 3 months ending the 30th of June 2025, they reported a loss of $55.9 million. Compare that to the same period last year when the loss was $30.4 million. That is a pretty significant jump in losses. Looking at the first 6 months of the year, the picture is similar, a loss of $68.5 million in 2025 versus $76.3 million in 2024. So while the 6-month loss is slightly better than last year, the trend for the quarter is concerning. On the revenue front, it is a mixed bag for the second quarter of 2025. Revenue was $208.4 million, up 3% from $202.2 million in the same quarter of 2024. That sounds good, but then there is a caveat. A lot of that reported increase is due to currency exchange rates. If we look at the revenue in constant currency, meaning we remove the effect of changing exchange rates, revenue actually decreased by 0.2%. So the underlying business in local currencies is slightly weaker. For the first 6 months of the year, the story is also similar. Reported revenue is up slightly by 1.1% to $405.9 million. But again, strip away the currency changes and revenue is up a tiny 0.2%. It seems Oatly is really feeling the effect of currency swings. Digging into the segments, Europe and International is still the star performer for Oatly. Revenue here grew even in constant currency terms for both the quarter and the first half of the year. This is likely due to a strong retail performance and expansion into new markets. However, North America is a different story. Revenue declined both in reported and constant currency terms. This seems to be driven by a drop in sales within the food service sector. Greater China also saw a revenue decline in constant currency terms, though a new food service customer helped to soften the blow in reported numbers. It is clear that North America and China are facing tougher headwinds. Now let us talk about profitability. Despite the revenue challenges in some areas, Oatly managed to improve its gross profit margin. For the second quarter, gross profit margin reached 32.5%, up from 29.2% last year. For the first 6 months, it rose to 32% from 28.1%. This improvement is largely thanks to better supply chain efficiency, particularly in Europe. They are also benefiting from economies of scale in purchasing. This is a positive sign showing they are getting better at managing their costs. Interestingly, research and development expenses saw a big drop, down 57.7% for the quarter and 42.1% for the half year. This is mainly because the prior year had higher expenses related to a new product launch issue. It looks like they are cutting back on R&D spending, which could be a move to conserve cash or a strategic shift. Selling, general, and administrative expenses remained relatively flat, but as a percentage of revenue, they actually decreased. This indicates some success in their cost-saving initiatives, which is crucial when revenue growth is not firing on all cylinders. Now for a big one, finance costs. The company reported a significant finance expense of $31.9 million for the quarter, up from a finance income of $10.4 million last year. This massive shift is largely due to fair value changes on their convertible notes and increased net interest expenses. For the first 6 months, finance expenses were $22.5 million compared to $7 million last year. This surge in finance costs is a serious drag on their bottom line. All these factors combined lead to larger losses. The net loss for the quarter more than doubled to $55.9 million. The loss per S-hair also worsened. This is a critical point for investors to watch. Looking at their cash position, Oatly had $67.9 million in cash and cash equivalents as of the 30th of June 2025. They also have access to a significant amount of undrawn credit facilities. However, their operating activities continue to consume cash, using $15 million in the first half of the year. This cash burn, coupled with the increased finance costs, highlights the need for careful financial management. Free cash flow, which is cash from operations after capital expenditures, was a negative $25.7 million for the first half of the year. While this is better than the previous year, outflow of over $100 million, it is still a negative number. meaning the company is not generating enough cash from its core operations to cover its investments. A major element influencing their finance costs and financial structure are their convertible notes. These are essentially debt that can be converted into stock. The company has issued a substantial amount of these, and the terms, including interest rates and conversion prices, are quite complex, impacting their financial statements significantly. The report details extensive changes and resets to debt covenants and facility agreements, showing ongoing efforts to manage their debt structure. The segment details show how varied the company's performance is. While Europe and International is showing growth and improving adjusted EBITDA, North America is really struggling with declining revenue and negative adjusted EBITDA. Greater China is also showing weakness in constant currency revenue. The corporate costs, which are those not allocated to segments, are quite high, especially when looking at the significant negative adjusted EBITDA they represent. These central costs are a substantial part of the overall financial picture. The company is clearly focused on cost optimization. They've simplified their structure, reduced employee count, and are continuing with an asset-light supply chain strategy. This means they are relying more on external partners for manufacturing to control costs. Decisions like discontinuing construction of facilities in the UK and the US and closing the Singapore facility are all part of this cost reduction and simplification effort. A significant point of interest is the strategic review of their Greater China business. They are looking at options like carving out the segment to speed up growth and maximize value. While this could unlock potential, it also signals uncertainties and challenges in that market, and there is no guarantee of a successful outcome. The risk factors section is extensive, covering everything from inflation and supply chain issues to brand reputation and cybersecurity. They acknowledge their history of losses and the ongoing need for capital. The risk that they might not achieve or sustain profitability is highlighted, especially with rising costs of transportation, energy, and materials. Furthermore, their reliance on a limited number of suppliers for key ingredients is a clear vulnerability. Scroll note, looking at these numbers more broadly at Oatly. They are a company in transition, trying hard to balance growth with profitability. The improvement in gross margins is a definite positive, showing their cost control efforts are starting to pay off. However, the increasing finance costs and the weakening revenue in key markets like North America and China are significant concerns. The fact that currency fluctuations are masking the true organic revenue performance is also not ideal. They need to see a sustained improvement in constant currency revenue and a better handle on their finance expenses to truly turn the corner. The company's strategy of simplifying its structure and pursuing an asset-light model seems necessary given their financial situation. However, the success of this strategy hinges on effective execution and favorable market conditions. The strategic review of their China operations introduces both opportunity and risk. The main takeaway is that while Oatly is making strides in cost management, they still have a long way to go to achieve sustainable profitability and consistent revenue growth across all markets. Alright, that is our breakdown of Oatly's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.